The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and/or legal advisors before implementing any transactions and/or strategies concerning your finances. And with that, let's get to this week's episode.
Hi, I'm Jason Nickerson, President and COO, and this is Financial Focus. On this week's episode, I thought we'd continue with the income tax theme, given that we're only a few weeks away from the filing deadline. And probably one of the more controversial areas in all of finance today is digital assets or cryptocurrency. So I thought I'd bring this up in the income tax context simply because there is mixed messaging out there in terms of what cryptocurrency really is and how is it taxed. So I think first of all we need to understand that digital assets and cryptocurrency are not securities for the most part. There are some that may be classified as securities, but for the most part they're really not securities. But that doesn't make them any less taxable in the transactions. Also, this is an important topic for current times because the access to invest in these assets has become much easier, and we're able to gain access to buy and sell and even earn income off of these assets from companies like Coinbase and other avenues and other exchanges. So this isn't going to be a master class in taxation on these types of assets. I just really want to cover a few of the main types of how we see investors interacting with this new asset class. So first of all, the IRS is clearly trying to send the message to taxpayers that your transactions in these assets are taxable. If you look at the front page of your 1040, just below your personal information, the IRS places a question of have you bought, sold, or held digital assets? And so it's very prominent. And it's really to raise awareness, because the other issue that we're seeing is based on how people are buying and selling and interacting with these assets, the reporting is also not the same as your traditional investments like stocks and bonds and mutual funds and so on. You're not necessarily getting 1099s, 1099 dividends, or 1099s reporting interest and capital gains. So there may be some self-record keeping that you have to do, and there's some apps that we'll talk about in a little bit. So first, let's talk about the first most common transaction is just simply buying and selling. Now, when we go out to an exchange company like a Coinbase or somewhere else, and we invest money in a cryptocurrency like Bitcoin, Ethereum, Cardano, and others, that is not a taxable transaction upon purchase. However, it does start our record-keeping phase of this journey, right? Is we have to make sure that we're noting the date and the purchase price of these assets. Because at some point in the future, when we do sell these cryptocurrencies, that is a taxable or that is a reportable transaction. And so this is the most common that we can draw similarities to when we're buying stocks and bonds, mutual funds, and exchange traded funds. We buy in at a certain price and at a certain date, and then we sell at a certain price and a certain date. And based on our holding period, we'll report that transaction either as a gain or a loss. And the reporting periods are even the same. If we held it for less than a year, it's short term. If it's longer than a year, then it's long term. So at least there's some familiarity with those. But let's talk about a couple of others that maybe we're not as familiar with. Staking is another way that we can earn money from interactions or investments in cryptocurrency. Staking, we tend to think of that like depositing money into our bank and earning interest on the bank account. Staking is where we invest in a cryptocurrency and we stake it. And again, we're not going to get into the technical details of what staking is, but then we can earn money back for staking our coins. Now we earn that back. It appears when you're interacting with those as an interest rate, but we're earning that back in the form of additional cryptocurrency. So we have now a couple of reporting points there. Number one, we have the receipt of the staking rewards, and that is ordinary income, which is reportable in the year that we receive them. But now we also have additional record keeping. When we receive that new cryptocurrency, we have to make note of the value on the date received as well as the date we received it, because that is now our basis in the cryptocurrency. Okay. And then if we sell that into the future, we may have multiple cost basis amongst our cryptocurrencies to figure out our gain or loss. The other thing to note is there will be fees to buy and sell, and those are added to basis or factored into the gain or loss calculation as well. And then the third most common transaction that we're seeing or interaction with cryptocurrency is called learn to earn. And that is where you can simply watch a video or a presentation and earn cryptocurrency for doing so. And again, that is similar to staking, where you're going to have to report that as an income transaction and then make note of the value and the date that you did earn that, because that becomes part of your basis calculation for when you sell at some point later in the future to figure out if you've got a gain or loss, and there is another reportable transaction. So again, those are the three most common. There are certainly other ways to earn money in cryptocurrency, and this is not a master class, so we won't go much further than that. But just understand that you do have potentially some self-record keeping, because not all exchanges or custodians or entities provide those tax reports, those 1099s like we're used to getting from other custodians when we're trading stocks, bonds, and funds. However, there are some apps out there that you might be interested in looking into that can help reporting, especially if you are trading on multiple exchanges and holding cryptocurrencies in different wallets. One of them is by the name of Coinly, Koinly, and these come sometimes at a price where you have to pay to get your tax report, but you connect all of your different holding places, and it pulls the transactions from the blockchain and summarizes that into a tax report for you. But again, you can also do this by creating your own tax report if the exchange doesn't do that for you. And there is some upcoming legislation this year where some exchanges are going to be required to provide tax forms. So pay attention to that. So again, this is not a simple topic, but these are the most common transactions that we're seeing in cryptocurrency. And as always, talk to your tax professional, your accountant, and so on if you have interacted, invested, and traded with cryptocurrencies for more details. Thank you for watching this week's episode of Financial Focus, and we'll see you next week.